Now that you have been introduced to basic options terminology and have some familiarity with the way the options marketplace works, let's take a closer look at call and put contracts. Let's review some of the standard contract terms that were covered earlier in the course and the basic concepts of buying and selling calls and puts by clicking on the examples below. Buying one standard American-style XYZ October $60 call option gives the buyer the right to buy 100 shares of XYZ at a price of $60 per share between now and October expiration if the buyer exercises their contract. This is known as being long the contract, and the buyer is also known as the purchaser or holder of the option. Writing one standard American-style XYZ October $60 call option gives the writer the obligation to sell 100 shares of XYZ at a price of $60 per share between now and October expiration should the writer be assigned on their contract. This is known as being short the contract, and the writer is also known as the seller of the option. Buying one standard American-style XYZ September $75 put option gives the buyer the right to sell 100 shares of XYZ at a price of $75 per share between now and September expiration if the buyer exercises their option. This is known as being long the contract, and the buyer is also known as the purchaser or holder of the option. Writing one standard American-style XYZ September $75 put option gives the writer the obligation to buy 100 shares of XYZ at a price of $75 per share between now and September expiration should the writer be assigned on their contract. This is known as being short the contract, and the writer is also known as the seller of the option. In the case of either a standard equity call or a put option, the buyer of a long contract has the right to exercise the contract at any time up until the option's expiration. As we've already discussed, the option owner is in control of this. When and whether to exercise the contract is totally at the owner's discretion. For this right, the buyer pays the option's premium or price to the seller. Conversely, the seller of a call or put option has a contractual obligation to fulfill the terms of the contract if assigned an exercise notice. This assignment can occur at any time until the option expires. For this obligation, the seller receives the option's premium from the buyer. If a call owner exercises the standard contract, cash from the call exerciser's account is debited to purchase the stock and credited to the assignee, who then delivers the appropriate number of shares to the exerciser. If a put owner exercises their option, cash is credited to the put exerciser from the assignee, who, in turn, receives the appropriate number of shares. Though we have already discussed OCC's role as a CCP, it should be noted that OCC also plays a pivotal role in the assignment process. When contracts are exercised, OCC is the entity that randomly assigns an OCC clearing member firm, who then, in turn, assign one of their customers that holds a short contract position with the same terms as the buyer's contract. As the option holder, it is worth noting again that the premium paid to own the contract conveys certain rights upon the investor. First and foremost, the contract holder has the decision-making power as to what comes next. 1. The option contract may be sold in the marketplace if it has market value at the time. The investor may want to sell the call or put to either realize a profit or to reduce a loss on an unprofitable position. This sale, of course, must take place on or before the option's last trading day. A market quote, or bid and ask price for the contract, may be obtained through a brokerage firm or an online quote provider. Any order to buy or sell an exchange-listed option must be placed through a brokerage firm. 2. At any time up to and including expiration day, the investor can decide to exercise the contract and call upon the seller to fulfill the terms of the contract. Later in this course, we will explore when and why an options holder may wish to exercise their call or put. 3. If the contract no longer has value at the end of its term, the holder can simply let the contract expire. Though the option seller accepts specific obligations in return for collecting premium, sellers still have ways of managing the position, 2 that they can control and 1 that they cannot. 1. Sellers can often close out the position by buying back the contract in order to reduce the short position or exit it altogether. As only those with short positions after the close of business are subject to assignment risk, closing out the position ahead of time by buying back to the market is the only way to avoid unwanted assignment. If a seller is short a call and closes the contract, they are no longer obligated to sell shares. If they were short a put, they are no longer obligated to buy the shares. 2. Another choice is to let the option expire if it has no market value as expiration nears. Once expired and without assignment, the obligation ends as the option ceases to exist. However, this alternative involves some market risk. As the end of trading for your expiring option approaches, an unexpected market move in the underlying stock may make the seller vulnerable to assignment at the last moment. Why is this a risk? If they are assigned unexpectedly, they will be making either a stock sale in the case of a short call or a stock purchase in the case of a short put that they might not have planned on. 3. Accepting the risk of possible assignment is the final alternative for the options writer. However, the investor must recognize that they have no control over possible assignment on the short contract. Again, as long as they have an open short option position from writing a contract, they may be assigned an exercise notice at any time up to and including its expiration. Their only control over not being assigned, if they do not wish to be, lies in the potential of closing out this short position before assignment is made. After market close, exercise notices are processed and assignment notifications are generally received either overnight or the next morning. As such, assignees are subject to market risk as overnight conditions and worldwide events can lead to drastic changes between the closing price of shares one day to the opening prices the next. With this in mind, short contract holders must be prepared for possible overnight risk and manage the position prior to market close in order to avoid assignment. Regardless, investors should be familiar with their brokerage firm's procedures and timing for notifying its customers. Once they have been assigned, it is too late to close out the position, whether notification has been received or not. When assignment is made, the obligations to buy or sell the underlying shares must be met that day. When it comes to investing, options are extremely versatile. With options, a savvy and educated investor can employ any one of a variety of strategies to acquire stock, potentially generate income, or mitigate overall financial risk of their portfolio. And because of this, there are different motivations and market outlooks for buying and selling options that may not reflect the characteristics we've already discussed. For example, while buying a put may be used for a bearish speculation on a stock, it can also be used to protect shares already owned by the investor. Or, in the case of calls, one investor might sell a call to generate additional income on shares owned, while another is speculating a downturn in the market. The point here is twofold. The flexibility of options may allow investors to achieve their financial goals in any number of different ways. And the objective of one investor buying a call, let's say, need not be fundamentally opposite that of the investor selling that call. It is often said that options are a zero-sum game, where one wins and the other loses. This is not necessarily the case, as we cannot tell what the motivation or reasoning is of the counterparty to our trade. It's entirely possible that both sides may come out ahead. Let's take a moment to make sure that you have understood some of the concepts we have covered so far. Match the terms and concepts on the left with the definitions on the right by dragging the terms to the appropriate definition. Thank you for taking the time